So yeah, we're just gonna quickly get into vertical spread. We'll just touch on this on one of the basic strategies that's very commonly used, probably one of my most commonly used strategies for these very reasons. But a vertical spread is an options trading strategy that involves buying and selling options of the same type, either both call options or both put options. So you can do this if you're bullish or bearish when you're selling options, and on the same underlying or security with the same expiration date, but at a different strike price. So again, a vertical spread is where you sell two options on the same underlying with the same expiration date, but the only difference is you're selling both of those. You're selling one and you're buying one at a different strike price. So in a vertical spread, the option bought and sold have the same expiration date, but different strike prices, creating a range within which the trader expects the price of the underlying asset to stay. So it's a very directional trade. There are two main types of vertical spreads: bull vertical spreads and bear vertical spreads. A bull vertical spread is constructed using call options with lower strike price option being purchased and the higher strike price option being sold. And then it's the inverse for a bear vertical spread. So again, we're selling a put and then we're going to buy a put further out to hedge the one that we sold. So when the one that we sold is making money, the one that we bought will be losing money. And when the one that we bought is making money, the one that we sold will be losing money. So we're making that difference between that spread when one is making and losing money. That's why it's called a vertical spread, because we're trading the spread between the strike prices. And which is the difference of value. So that's pretty much the basics of vertical spread. But vertical spreads offer limited profit potential and limited risk compared to simply buying or selling individual options outright. The maximum profit and maximum loss are both capped and defined at the same time entering the trade. So this is kind of the conversation. I think I was talking about this with Wachuku. If you're ever surprised at a loss that you take in the market, yeah, that's a problem. If you don't know your potential loss before you get into a trade or have an idea or an estimate, if you don't, then it's just a lack of due diligence. And I think a lack of due diligence is a lack of discipline. But you should never really be surprised at the loss you take. Are you surprised? Like, even if you're selling an option strategy that's not defined risk, you have an idea of where you might get out. One of the times if you're undefined risk where you could be surprised is if the market makes a large move overnight where you had no control of and you weren't able to get into the market at that time, and the market has like a massive gap up or a massive gap down, and then you wake up maybe down like 3 or 4 times the credit received on the trade. That's a time in options or in a position where, it wasn't much in your control. But if the market is open, you got to know your game plan. Are you getting out at 2 times the credit or 3 times? You got to know these things before you get into a trade. And then, Wachuka and I were also talking about how much you lose is the only thing you have control over in the market. You can't control how much you make. You can't control if it's a green trade. You can't control if it's a red trade. You can't control how much you make if it's a green trade. The only thing you can't control is how much you lose. It's so funny because that's literally the only thing we have control of in the market. We can use probabilities, data, statistics, all we want to our advantage. But at the end of the day, we can only control how much we lose. So it's just another emphasis on risk management. And the difference in premiums, in the last bullet point, the difference in premiums between the options bought and sold determines the initial cost or credit of the vertical spread. This net premium reflects the maximum potential loss for the trader, which occurs if the underlying asset price moves beyond the break-even points of the spread. So a vertical spread is pretty straightforward. Again, we talked about knowing what your reward is and potential risk is on the trade before you get in. Your maximum profit is going to be the credit that you receive on the trade. So if I collect $1.60 when I sell this vertical spread, the most that I can make on this trade is $160. If it's a $5 wide and I collect $2 worth of credit, the most I can make on this trade is $200. What's my maximum risk? That's going to be $300. Because if it's a $5 wide and we collect $2 worth of credit, we still have that $5 wide and we collected $2 worth of credit. So what we have left is $3, which would be our max loss. And that's one thing that is my favorite about vertical spread, is just because that max loss is also capped. So it's cool that I can get into a short position with capped losses. Like if I'm trading stocks outright and I'm shorting these stocks, an underlying can theoretically go to infinity. And an underlying can have a massive gap up the next day that I have no control of, and I'm short however much capital or however much shares, and there's nothing I can do about that. But with the vertical spread, you can kind of just sleep good at night. That's why whenever there was an earnings and I did take part in an earnings trade, it would just always be a vertical spread because I know how crazy they can be, and it makes me feel comfortable that my losses are capped. But that was a lot of talking. I was past like 30 minutes. I literally need some water.
A little yap sesh for past 30 minutes.
I was literally
I feel like it's always nice though, just having not predetermined outcome, but predetermined case scenario. Like, you know, the worst, the best.
Yeah.
Kind of just let it be and do what you can.
100%.
Versus like the limbo of like, oh, like actively being it, like, oh, that got to be 10 out of 10 worst.
Yeah.
Top 10 worst feelings ever.
Top 10, top 5,
top 10 worst feelings ever. Reminds me of the 1-3-2 spreads or whatever the ration is.
1-2-3 spreads.
Ration.
But yeah, we are kind of running out of time. I'll keep updating, letting you guys know how the footprint stuff is going, and let you guys. And I'm just gonna keep sharing everything that I'm learning with it because it's pretty cool. We'll see. Just need to stay disciplined. Excuse me. Prepping for trades was super important. That helped so much last night before I went to bed. I just, went into the charts, prepped, marked out those supply and demand zones and what they meant, did all those kind of stuff. And then kind of the idea was just to see how price would react to those today. So didn't know I was going to take any trades, but I'm going to keep taking that approach. I'm just going to keep prepping. Sometimes we might get opportunities. Sometimes we might not. The market's not going to be trending every day either. So just going to have to be patient and act and understand that, manage expectations properly. And then see how consistent you could just be being disciplined and sticking to what you need to be waiting for. But anyways, that's enough yapping for the day. Anything to add before we hop on out of here, T?
Nah, that'll pretty much be it. If you guys are on the YouTube, if you haven't check out our app. You could also watch our streams or previous streams, see some of the topics we went over. But other than that, that'll be it.